Hi there, welcome to the PRUSKOP Podcast. Megan, the realtor here from Edmonton, Alberta. Today we're going to talk about the most common types of investor strategies in real estate. We're going to start off with the most beginner-friendly ones and then slowly move more and more towards the advanced strategies. I'll give you the standard property type that you should be looking for and pros and cons that you should consider before you deploy any of these strategies. Let's get into it. The most beginner-friendly version of real estate investing is buying and holding. This is personally my favorite strategy because it is the safest. There is risk to it that we'll get into in a second, but when you're looking at a buy and hold property, you should be looking for one that's in great condition, aka turnkey. Turnkey means that there's nothing really you have to do to it. Maybe you have to paint, maybe you got to replace the floors, but virtually it's in live-in ready condition. It's good to go. All you have to do is put the key in the door, turn it, and it's livable. That's where the term comes from. A con with buy and holds is that you can't squeeze more juice out of them, at least on the physical aspect of the property. Since it's already in very good condition, doing renovations doesn't make sense to improve the value of the home. If it's already in perfectly fine condition, why would you tear it out and replace it? It doesn't make sense. You might be able to squeeze more out of the property if the rental rates were below market rents and you think that the market could support higher rents than it's currently being charged. You can squeeze it out that way. You can also rent by room rather than rent by floor and get more money that way. You can also go Airbnb. Another way you can force it to cash flow better is if you put a larger amount of a deposit down, which means that your mortgage will be less, which means your monthly payments will be less, which means it should free up some of that cash flow for you. Other cons with buy and holds is that you got to be patient. This is not the get rich quick way to go of real estate investing. This is the generational wealth building strategy. You got to be patient and you're going long if I were to use stock terms. You're just waiting for it to naturally appreciate and go up in value with time. The next property investment or the next investment strategy we'll talk about are BRRRRs. BRRRR stands for buy, renovate, rent, refinance, and repeat. When you're looking for a BRRRR property, you're looking for one that's a little bit worn down, maybe very worn down. It really depends on your comfort level and how much work you want to bite off. That's up to you. BRRRRs are a hybrid between flips and buy and holds. So just like the name says, you buy a property, then you renovate it, then you rent it out, and you should be able to get more rents now than you were getting before because the place looks a lot nicer. And then you refinance it. So let's say that you bought the home for $300,000, you put $50K worth of renovations into it, then you approach your bank and you say, hey, it's fully rented out. Look at this. I know it's worth more than $300K now. Can you reappraise my property? They'll come back and they'll say, yep, it's worth, I don't know, $400K now. So now you refinance your loan and the property has been marked as worth $400K and you may be able to pull some of that equity out depending on how much of your spread was. We won't get too much into that, but essentially that's how it works. You hold on to that property and you just keep renting it out. So you're still holding on. You got a little bit of active appreciation out of it by doing those renovations. You got to pull some equity out, which is great for some active income, but you're still relying on long-term appreciation as well. BRRRRs are great too because you have that long-term appreciation helping you out, where if this property didn't quite make sense as a flip, it might make sense as a BRRRR because you have more time to let it grow, let it become worth more. Some cons with BRRRRs are it can be complicated depending on the level of renovations that you are doing. Make sure you're not biting off more than you can chew, or if you are, make sure you're partnering with somebody that has sufficient experience. Something to be aware of with BRRRRs is the financing that you get on the property as well, depending on the timeline of the renovations. If you're doing a really slow BRRRR, then maybe you could have a 3-year fixed or a 5-year fixed. And as tenants move out, you'll update the bathroom. And then the next tenant moves out and you update the kitchen. And you can slowly go about it that way. But if you're wanting to purchase a property and right off the bat do a full gut renovation, then you should either have a bridge loan or a floating loan on the property. Because if you lock yourself into a 5-year fixed term and then you want to refinance in 6 months once the renovations are done, in order to escape that $300K 5-year fixed term mortgage, you're going to have to pay a mortgage penalty, which is typically 3 months of interest, but it could be different depending on your bank. And then you would refi into the 400K loan. So you're paying a fee there that you could have avoided had you chosen the right financial product. The pros, once again, is that you both get active and passive appreciation on your side. The next one that we'll talk about are flips. I don't think I need to go too much into this one because that's what most people are familiar with. We were all raised on the TV shows of move that bus. Trust me, I was too. Essentially, you would buy that $300,000 house, put 50K worth of renovations into it. Now it's worth 400K, so you list it for 400K and you sell it for 400K. You don't hold on to it, you just get to keep that 50K difference. For the advanced people listening, yes, you wouldn't be able to keep all 50K because there are additional fees that you would have to pay for closing, etc., but just run with me. The next one that we'll move on to are infills or redevelopments. When you infill a property, you're looking for one that is super beat up, pretty much not inhabitable or not inhabitable at all. And with these properties, you're knocking down the old crappy house and you're building a nice new big shiny one in its place. This can be a single family detached, this can be row housing depending on the lot size that you have. This is also the hardest way to go. And the reason why it's hard is there's a lot more layers to it. You're not simply repainting the place. You have to get permits in order to demolish the original house that was there. You have to do asbestos abatement, most likely, which also costs money. You have to hire an architect to do the drawings for it. You have to make sure that your structure falls within the municipal bylaws and codes. And you have to have big pockets as well. Most of the time, when you're doing infills or redevelopment, you're paying for the land in cash, which depending on where you're looking can be anywhere from 250K all the way up to 600K. Actually, sky's the limit. So you just really got to make sure that you're very experienced, or once again, you're partnering potentially with a GC that has a ton of experience that you can leverage. And you also have to have deep pockets. Another thing is the timelines are a lot longer with infills than any other investment strategy. And that's mostly because of the permitting process, if I'm honest with you. When it comes to the physical construction, like breaking ground and actually building something, for a standard 2-story home, it's usually around 6 months. If you want to go the 8-unit row townhouse infill style, just the construction part takes between 8 to 10 months, and the permitting process alone takes about 4 to 6 months. So you can see that eats up a lot of time. So you got to be able to make sure that you can float that property throughout that entire duration as well, and also pay for the construction costs or get financing for the construction costs and the land costs. There's just a lot more to it, but it can absolutely be done. Typically, you're going to make more money with infills than you will with flips. But in order to get into infills, you have to be able to put more capital in to get more capital out. That's true with flips too. With flips, on average, you're going to be getting around 30K if you do it properly. That's just the median that I've heard from flippers in the area. That is a take-home number after all expenses paid. Each flip, if done properly, should net you around 30K. When we're talking about infills, it can really depend on what kind of product that you're building, what the land price is when you bought it, what the structure is that you built, what area are you in. There's a lot more factors to it. So looking at your ARV for an infill can also be a little bit more difficult if there haven't been redevelopments in that area already. That's it. That's all. I hope that wasn't too confusing and that you guys understand the basic strategies that are deployed by real estate investors all around the world. If you have any questions, drop it in the comments down below. As always, like and subscribe. It helps me out a ton. I hope you have a fantastic day. Bye for now.